On a scale of 1 to 10, how busy were the last couple of days for you?
Well, we've made a point of speaking to the vast majority of our clients just to keep them in the loop as to what's going on. I think most seasoned investors have seen the turbulence we've enjoyed over the course of this week before.
And it's enjoyed?
Well, I think markets, they ebb and they flow. They're cyclical. We're always going to have corrections and setbacks, and we're going to have bull runs as well. So I think with experience, you learn to ride the momentum a little bit more easily than the novice investor, maybe.
And you find that your clients are, for the most part, calm?
Yeah, I think it'd be fair to say that we had obviously some fairly decent corrections at the beginning of the year. Markets fell off by 14% in the S&P 500 in January. So these corrections we've seen over the last week have been short and sharp and aggressive. But by the same token, there isn't any one specific catalyst that has made this happen. So there's not a big piece of one-dimensional news flow that's been the catalyst for it. There wasn't a specific trigger? No specific trigger. I think there's been a number of different things that have come together roughly at the same sort of time. We've obviously heard from the IMF, and they've come out with commentary, which has maybe downgraded expectations for growth globally over the next 12 months. We've also seen the US debt market, specifically the 10-year US Treasury debt yield, now over 3.25 earlier in the week. It's ebbed back a little bit, but it's beginning to show itself as a realistic alternative for investment money to go towards. And we've also maybe seen a continuation of economic data out of the US continuing to improve. And I think we've maybe reached that tipping point whereby good economic data out of the US is actually being viewed slightly negatively because it just ramps up the expectation for the Fed to start tackling inflation and raising interest rates.
Well, now that you we brought up a lot of things in the last couple of minutes, but we want to break this down in just in a few different sectors, shall we say. The banks, we saw the Q3 earnings. Is this what you're talking about? That even in spite of higher than expected returns, it's not going to be looked on positively?
Markets are always analysing what's going on today, but always looking in the future and factoring in the future. And when I say we've reached that tipping point with interest rates, increasing interest rates mean that it's more attractive for people to put their money in a bank account and get a return from that, or put it into US debt, for instance, and get a decent yield from that, than investing it in the stock market. So there is down the road, there will be a cooling of the equity markets on the back of the US raising rates. The banking sector is a bit of an odd beast in so much as higher interest rates improve their profit margins. And the US banks have had, banks globally have had quite a lot to contend with since the financial crisis, increased regulation, which has seen many of them, almost all of them in fairness, have to completely go back to the drawing board as to what their business model is. And I think you touched on the figures earlier about JP Morgan and Citigroup. Both of them, as far as their earnings per shares were concerned, EPSs were concerned, were positive, better than expected by the markets. Wells Fargo, though, is maybe aligned somewhat differently. It's had a lot of negative press over the last 12 months. It's had a lot of fines it's had to contend with as well. And I think the perception, as far as they're concerned, was somewhat negative already anyway.
Yes, that definitely not a good year for Wells Fargo. Now, if we look a little bit at the banks in Switzerland, I mean, they were also reacted to the sell-off a couple of days ago, not recovering quite as fast as the U.S. markets. Why do you think that is?
Well, U.S. markets and U.S. equities always move more aggressively, whether it's corrections or bounces, than equity markets globally. And I think, again, when we're talking about interest rates being the real benchmark of how retail banks, that's the way their profit margins come in. As we know, interest rates here in Switzerland, in comparison to the U.S., and the cyclical interest rate rising process is years behind the US. And subsequently, the likes of UBS and Credit Suisse and all the other Swiss banks have that to contend with.
Now, you were talking about earlier about interest rates. I mean, this crazy week that we just had, what role did the Fed and the rate hikes at the Fed really play? I mean, do you agree with President Trump that Fed is responsible?
Well, I think...
Putting on the spot. But
yeah, no, well, look, I think as far as the Trump administration is concerned, and specifically President Trump's Twitter handle does like to throw around the accusations quite freely. I think as far as the Fed's concerned, they're an independent entity that are responsible primarily for keeping inflation under control. And as we speak, the US inflation rate is round about that level, 2% circa their target. That's why they're raising interest rates, to combat that. They don't want the economy to overheat, and that's why they're raising rates. Donald Trump, the US president, doesn't really want that for his primarily political reasons. But as far as the economists are concerned out there, midterm elections as well, as far as the economists are concerned, though, it is, it's night follows day. This is the exact course of action we would have anticipated from the Fed. And let's be clear, the Fed have been very clear on their interest rate path for a number of months, quarters, years even.
Right. So you don't think that we could see another sell-off as the interest rates continue to climb?
Undoubtedly, as interest rates rise, the enthusiasm for the equity markets will be cooled by that as a counter effect of it. So markets are cyclical. I'm fully in the belief we'll have another correction. I'm fully in belief we'll have another bear market.
By correction, you're meaning sell-off, like what we had 2 days ago.
Yeah, I think, when we look at the markets, certainly the US markets, they're still positive on the year. European markets, not so. But US markets are still positive. And let's face it, the fundamental drivers of the markets in America have been low unemployment levels, improving average hourly earnings. So more people are working, they're earning more money. And it's sales figures from the corporates. In the last reporting season that we had, last quarter, it was increased sales that were driving the corporate story. So from that point of view, it's still a very positive picture.
All right, but still, the downturn is hard to escape.
That's true. And I think human nature plays a big part in this. When it comes to markets moving too far in any one direction, whether it's sell-offs or bull markets, there is always that contrarian mentality that materializes in humans, and they start to second-guess themselves. They get a little bit nervous. I think if you were to ask wealth managers like myself globally, what's your stance on the markets at the moment, we'd probably, if we were holding our hands up, say we are nervous bulls. We're invested in the market, we're long of equities, but we are conscious we're closer to the end of this bull cycle than we are to the beginning.
Talk to me about the tech stocks now. We mentioned they were the hardest hit this week, but also seem, as we saw earlier, seem to have recovered.
Yes, I think the tech stocks...
Were they overvalued? Was consolidation necessary?
You can make a very easy argument to say that a lot of tech sector stocks are overvalued by the old metrics that we used to use. They are the new modern day equities out there and companies out there, so they do have different business models. I think as far as the correction is concerned, anything that's overextended on the upside is more likely to be overextended on the downside when the corrections come. So it's no real surprise that it was tech sector stocks that were most aggressive, sold off equities, and by the same token, most aggressive in the bounce.
So would you say is it a good time to look into those tech stocks?
I think if you were...
Without giving investor advice, but...
individual circumstances aside, seeing a decent correction, that's what people have been looking for. And if we look at the last 5 years of the markets, every time there's been a decent-sized correction, the investment community, by and large, have taken that as an opportunity to invest in the market. I think the enthusiasm of those bulls to jump back in to sell-offs has diminished as time goes by, and that's maybe what we've seen.
So we'll see there's a little more uncertainty than anything else heading into this fourth quarter.
I think volatility this year anyway. Is escalated because of the geopolitical headwinds that many are seeing.